the world is full of uncertainty. Monumental challenges such as climate change, poverty, and inequality are at the forefront of daily life and are becoming increasingly urgent. One thing that isn't uncertain is the need for change. Business leaders are realizing the power of using sustainable strategies to address the world's most pressing issues while driving organizational success. One way to understand a business sustainability effort is by using the triple bottom line, a concept that posits firms should commit to measuring their social and environmental impact in addition to financial performance. Rather than solely focusing on profit or the standard bottom line, the triple bottom line comprises three pieces: profit, people, and the planet.
The first one is a profit. A company's success still depends on generating earnings for its shareholders. Strategic planning often focuses on increasing profit, lowering costs, and managing risk. In the past, many companies stopped there. Today, more leaders realize that business can drive positive change without harming financial performance. The second is the people. This component focuses on the company's social impact. It's important to distinguish between shareholders and stakeholders. Shareholders are the owners, while stakeholders include everyone affected by business decisions, such as customers, employees, and local communities. In a sustainability mindset, companies shift from serving only shareholders to creating value for all stakeholders. This can be shown through fair employment practice, supporting workers, and partnering with nonprofit to strengthen community impact. The third is the planet. This component highlights a company's responsibility to reduce its environmental impact. Large corporations have historically contributed heavily to pollution. 100 fossil fuel producers account for 71% of global industrial emissions since 1988. Today, many companies recognize this responsibility and take action by using ethically sourced materials, lowering energy consumption, and improving logistics to shrink their carbon footprint. While adopting the triple bottom line may seem idealistic in a world that emphasizes profit over purpose, innovative companies have shown that it's possible to do well by doing good.
ESG core pillars and supporting theory. Environmental, social, and governance are ESG core pillars. This disclosure standard focuses on three key dimensions summarized in ESG, and we start with economic pillar, which assesses how a company creates long-term value, not just short-term profits. And the answer is no. Short-term profits can damage the future. Sustainability is about growing value, measured by job creation, value-added distribution, tax contribution, and future-oriented investment policies. For example, FWD insurance, significant investment in digitalization, and inclusive service is a strong and sustainable economic contribution because it expands access to protection for many people. And the second one is environmental pillar. Even though they are not factories, service companies still have an environmental footprint, such as electricity, paper, transportation, and others. And the answer is, of course, every office, every operation leaves a footprint, from electricity consumption and air conditioning to paper use and employee mobility. All of these impacts must be managed. For example, Astra Insurance has implemented a digital claims system and an extensive paperless program as a concerted action to reduce its operational and energy footprint. And finally, there is the social pillar. This encompasses everything from employee occupational safety and health, training, human rights, to community contribution. If a CSR program is measurable, sustainable, and aligned with the core business, it will be a strategy that builds long-term trust. And number 4 is supporting theory, our stakeholder and legitimacy. All of these ESG disclosures are based on the theory that's strong. And the answer is consumers will abandon them, and it will be difficult to maintain their license to operate. This is explained by two important theories. And first one is stakeholder theory, which emphasizes that companies are accountable to all stakeholders, not just shareholders. And legitimacy theory, which explains that companies must gain and maintain social acceptance in order to operate. Their three pillars are an essential framework for measuring truly sustainable business.
Challenge and conclusions. The first, global and national standards. To ensure the credibility of information, the business world refers to global frameworks. The most widely used is the Global Reporting Initiative. Furthermore, new ISSB standards, IFRS S1 and S2, aim to strengthen the consistency and comparability of reports across countries. The answer is to make reports easy to compare across countries. Second, challenge and opportunities. Despite its importance, implementing this standard faces challenges. One of these is the risk of greenwashing, the practice of conveying misleading information to improve image without real change. The answer is only if the data is credible and audited. Some insurance companies are starting to attract ESG investors as their sustainability reports become more comprehensive. Third, closing. In closing, ESG is not an administrative obligation, but a future strategy. The answer is, in our opinion, the future of business depends on sustainability. Companies that ignore ESG will lose competitiveness, investor trust, and long-term resilience. Embracing ESG is not only about responsibility, it is about survival and future growth.